All right, this is David with Anderson Business Advisors. We want to thank everybody from around the country going in and logging in today to watch our webinar on year-end tax planning. And today we've got one of our CPAs in, going to talk a lot about tax planning and what's going on for the year. Ronnie here is going to give you a little bit of background on what he sees as some of the strategies and things that we as business owners should be looking at. So first off, I want to introduce Ronnie, and Ronnie, kind of give us a little bit of your background and what you've been doing for the last several years here in the CPA world.
All right. Hey, thanks, David. Appreciate all you guys being out here tonight. I know you guys are all over the country, and you know it's 4 o'clock here in Vegas, but in different parts of the world it's a little later. So I appreciate the time and appreciate you being on this call. My name's Ronnie Withager. I'm a CPA. Been doing this over 5 years now here at DG Anderson. I'm a tax manager. Coming out of college at UNLV, I started at McLeod Drive, which is the 5th largest accounting firm in the world. After a couple years there, I moved on to a smaller firm to be able to work with smaller clients and small businesses, and really found a good niche in the small business world, and found a lot of joy working with you guys and working with those types of clients. But throughout my career, I've been able to work on large and small companies, been able to consult with business owners to get to know them and really just kind of talk to them about what their challenges are every day. And you know, it's been really good for me to be able to work with the clients a little more hands-on. So you know, when they asked me to do a little year-end planning meeting here, for me that was great, because I hope that the things that I share tonight will encourage you guys to do some year-end planning and to give us a call. Every year in this November to December time, I sit down and talk to clients about what they have going on in their tax year, and you know, we try to project where they're going to be in April, how much they're going to owe. If there's any ideas that we can implement now between the end of the year that will ultimately help them save tax, we're happy to be able to do that during this time. And you know, what it takes on your end is to be the proactive business owner, is what I call it. You know, there's a lot of business owners that won't bother calling us at this time of year. But the proactive business owner, you guys who are logged into this webinar tonight, are ones that are anxious and interested to know, you know, what types of things we can do to save money. And you know, I'm appreciative of the type of business owner that isn't afraid to pick up the phone and have a real good CPA client relationship. And what that'll do is it'll save us time. It'll save us money. It'll bring value to you and your business. And you know, when you have the idea of what it's like to work with a CPA at DG Anderson, you'll appreciate that we bring value to you, and that value will come through regular communication. So.
Well, and Ronnie, let me jump in real quick on a couple things. One, there's a few people coming in right now into the webinar, and a couple of things that you mentioned earlier was that you want to kind of hear where people are coming in from, right? So yeah. So let's get people to, if you can, down below below the webinar here, where you see the video on the page at the bottom, you can type in your name and where you're from. That'd be great, so we can kind of get a feel for where people are coming in from the country.
Yeah, I'd love to see how far-reaching this webinar goes. Yeah, I'm newer here to DG Anderson, and the webinars that they do here is, in my opinion, a great idea. I'm just excited to be able to be here answering your questions tonight, but figured this would be a fun way to just kind of get familiar with that chat and being able to plug in where you're from. And then later on, when we get to that point, just fire away on what questions you have.
And what we've got down there, just so for those that are on the call, if you haven't been on one of our webinars before, on this page, you will see a little blue pop-up come up called live chat. Just ignore that, click out of that one. What we're saying is down below at the very bottom, you're going to see, add responses or whatever down there. And if you add any kind of responses down on the bottom there, we'll go ahead and answer your questions throughout the call. And then also, if you want to just right now go ahead and type in there where you're coming in from, what city or whatever, that would be great. And we're going to get this thing kicked off. What we're going to talk about today is year-end tax planning. We're going to give you some strategies for individual and business strategies, and really dive into a little bit of the law changes as well before we get into some of the strategies. And we'll start going in and looking at all of that and get Ronnie's experience based on what he's been doing already with some of our clients and seeing what's going to work for you that are on the call today. So let's start off, though, by just talking about tax planning when it comes to year end anyway. So as we start moving into December, which is only a few weeks away, believe it or not, as business owners, I mean, I've run my own business now for 15 years, and I'm an investor as well in real estate and that kind of thing. And it always seems like when the year comes towards the end, I'm looking at my numbers, I'm looking at financials going, man, how do I kind of start curbing some of these expenses or bringing in more expenses rather, and deferring income and looking at some of that stuff too. So I would love to be able to sit down, and which I now can now that I'm working here, but be able to sit down with a CPA and kind of start talking through some of those strategies. So tell us a little bit about that year-end planning from your perspective as the CPA who's going to sit down with people like myself that are business owners and trying to figure out what's next. So what does that look like?
Yeah, I mean, the thing that, I really enjoy about this job and kind of being trusted as an advisor is, just everyone's situation is a little bit different. I mean, all you guys out there have different things going on. There's pretty much no two clients who are exactly the same. So, if I had to get into, why is this year-end planning just so important? I kind of put a couple bullet points up there that I'd like to just go over. But, the first one is being able to defer or avoid taxes overall. And so, what I guess we can recognize and understand is that Uncle Sam's a little bit greedy. I mean, he wants his bottom line to increase as a business owner just as much as you do. So, these year-end tax planning meetings can really help, year over year, just avoid or defer some of those taxes. The other things is that laws are changing every year. It's my job to understand and know what those laws are. The business owner might have to focus their time and energy and effort into doing what they do, and may not have all the time to be able to fully understand those law changes. But we'll get into some of those law changes a little bit later on. Another thing is to be able to avoid interest and penalties. One major thing here is the underpayment of tax. If somebody owes over $1,000 of tax in the prior year, the next year they're required to pay estimated tax payments quarterly. And if those estimated tax payments aren't 110% of what the prior year tax was, then the IRS is going to give you interest and penalties on what you underpaid. And so oftentimes, the clients that aren't paying attention to, how much they're making year over year, end up, losing a few $100s just right off the top without, because they weren't being consulted and didn't understand how much they need to pay. The other thing is just that lack of communication that just sometimes exists creates mistakes that people make. And oftentimes when it comes down to those mistakes, we find out about them in March or April, and then the year's over, so we can't really focus on fixing them. And so you kind of mentioned, David, just what do we need to do sitting down at the end of the year? I mean, the first thing is just, if everybody's books are kind of up to date towards that October or November period, it's going to get us really close to what you're going to have for the year. And so me being able to kind of have an idea of what you have going on will let me look through everything, and it'll let me ask you the questions. And so, you might have all these books sitting in front of you. Hey, what can I do? I don't know what to do. But just me, who looks at these every day, can come up with 5 questions to ask you. And that might create, oh yeah, hey, I do that, and so there might be some opportunities through there that you could miss.
And so a big part of that is just not, we as business owners don't know what to ask, right?
Right.
And so you being in it every single day know what to look for and can see it. We don't necessarily know that deduction was even there,
exactly,
or whatever it might be, right?
Yeah, and you kind of just being organized and sending us a snapshot of what your overall picture's looking like, it is almost the book that I need to read to be able to know exactly what to ask you. So, once I look at somebody's books, I can tell if there's a few things that maybe we can work on there, or perhaps just because laws change and things like that, it's just other things to look for that like you've already mentioned, that you didn't really end up knowing.
Yeah, I mean, to your point, the biggest thing that I see that comes in is that there's so many different changes throughout the year with regard to how Congress and everybody else is going in, IRS is going in, whatever it might be, even locally. Things are happening, and with those changes, that I would think would be a big part of why we have to do the tax planning, because what worked 3 years ago may not work today.
Absolutely, yeah. And I mean, that's a great point that you make. I mean, we even look right now. I mean, there's expiring tax laws that are expiring right now, but a lot of times those things can be renewed, or they'll kind of continue on. But with this being an election year right now, everyone's afraid to even do anything because they don't want to politically change things. So I mean, honestly, even some of the stuff we might be looking at right now could be different 2 months from now if they retroactively fix some certain things. So we do the best we can with what we're given, but yeah, those laws are always changing, and I'm going to discuss some of the things that have changed and are different than what's worked 3 years ago, for example.
So Section 179. I mean, obviously that's a part of the IRS code. I'm assuming.
Is, yeah.
Talking IRS CPA lingo here. So give us an example of what kind of changes have happened with regard to that and bonus depreciation.
Good. Okay, so Section 179 allowed the taxpayer to fully expense in year one, if they wanted to do that, any business assets placed in service during that tax year, as long as it didn't go over $2 million. So if a business had income, and that's the key, you had to have income to be able to use Section 179, you would be able to fully 100% write off. I had a client last year who bought a truck that was a couple $100,000, and they were able to wipe out all of their taxable income just because they bought.
Did you say a truck for a couple $100,000?
Yeah, it's like a dump truck.
Okay.
Yeah. So, and then bonus depreciation, that didn't have the income limitation, but bonus depreciation allowed a 50% deduction in year one. So, both really, really good to the taxpayer to bring expense in, but as of right now, those are going away, and or they're being changed. And so the deductions aren't as good as before. But then again, we don't know, we don't know what's going to happen. They might just end up saying, hey, 179's back on. We're going to extend it 5 years. But for right now, we have to run off the assumption that bonus depreciation and 179 are severely limited, which hurts the business owner.
So tell us a little bit about the next one on here, tangible property regulations. What's going on there?
Yeah, this is a big one. And what I'm going to do is I'm going to plug our next webinar, which is going to go into tangible property regulations way more in depth with Rob McConnell next Wednesday. But this is a 500-page change and a huge regulation. But it has taken about 10 years for the IRS to get this thing nailed down. And, what's going to happen there is that what you have known would be something that is capitalizable versus just expensing to repairs and maintenance is going to ultimately change. And so, if you had a rental property in the past and you went and replaced the carpet, that would end up being capitalized, and you'd have to depreciate that over.
So this section, just to clarify, is for those that own property within a entity?
Yeah. So basically anybody who has a fixed asset schedule or who has property and assets in their business is going to see some changes with this regulation. And there'll be way more information to come on that, but it's just something I wanted to highlight as a major change.
And something that we should be asking our tax preparers about, that, hey, I've got, and that would be the question, right? Hey, I have tangible assets in my business. I understand that there's some laws or regulations that have changed regarding the property regulations.
Exactly.
Is that how they should say it?
Yeah, I mean, yeah, they could say it like that, but also it's something that's going to take into effect as of January 1st anyhow. So, the thing is that we're going to be on the hunt for it anyways, because, we're going to have to make elections and file additional forms to make sure that everybody's in compliance for it. So we're looking at it already for all of our clients. But I think if you're one of those people that falls into, you got a fixed asset schedule in your tax return, then you're definitely going to want to just go ahead and sign up for next week's webinar as well, because we're going to dig into that for a whole 45 minutes to an hour.
That particular webinar is for our tax team members, so you'll be able to log into that. You'll get an email here soon on that as well. So let's move on to a very non-confrontational, non-political thing called the Affordable Care Act. Tell us a little bit about the changes on that.
Yeah, the Affordable Care Act, it kind of took the business owner and especially the investor by storm last year with the net investment income tax, 3.8% on dividends, interest, royalties, the selling of partnership interests, etc. But anybody that, if you're married filing joint, 250,000 or above, or single over 200,000, got tacked on an extra 3.8%, an extra tax. And so that's still moving forward. But with the Affordable Care Act, the big thing this year is the penalties that are going to kick in for people who don't have insurance, but then also the new forms that we're going to be having to fill out. So, you'll have to take a look into the organizers that you send out, or that we send out, and make sure that, you're answering the questions when it comes to that. So yeah, just penalties and new forms is kind of the big thing with the Affordable Care Act. But yes, very politically charged. Wondering if it's going to be repealed from, I don't know. I'm not going to say, but yeah, there's some changes in the law there as well.
Definitely something to be paying attention to. So, real quickly, again, on a housekeeping thing, if you're going in and asking questions down here on the below the video, two things. One, do type in where you're from and then your questions down there. When you do that, the page does refresh. It brings you right back to the same page. All you have to do is hit play again, and it picks up right where you left off. So you're not going to miss anything when you do that. And for those that just joined us, there is a blue live chat window that pops up. Just ignore that one for now, but just ask your questions in there. And we'll get to most of those questions towards the end of the call here. So now that we've kind of talked a little bit about the changes and the laws, and just to clarify here, just again, it's making sure that people are aware that you really should be asking what are the changes, and asking your CPAs and your tax professionals that you work with, what law changes do you know of that are going to affect me, and what are things and directions that we need to go as we start moving forward, and making sure that they're very aware of what you're doing. And obviously, that's what our intentions here are with DG Anderson and Anderson Business Advisors, is to get an idea of where you're at and what you're doing. And obviously, we work with a lot of business owners all across the country. And so one of the first things we want to dive into right now is just start looking at, when it comes to year-end tax planning, from a business standpoint, what are some of those strategies that we could be using to help minimize the tax that we're going to end up paying, right? So give us some of these strategies here that you've laid out.
Yeah, so I laid out first deferring or accelerating income between 2014 and 2015. If they're, I'll use an example. if there are situations where, you might have a net operating loss on your C Corp, you might want to accelerate income into the current year so that, that NOL can just kind of wipe that out instead of deferring it to 2015 and ending up being in a different tax bracket.
And but NOL would be
net operating loss.
Okay.
So, so I mean, just kind of taking a look at some of that income and seeing if we can shift it between the 2 years, depending on, if you feel like you're going to make a lot more money in 2015, maybe you want to end up taking those expenses that you might, buy in 2014 and just saving them for 2015. This is kind of one of those ideas that really is dependent upon the person's situation. I mean, there's 100 different scenarios that we could run through that in talking about deferring or accelerating income, but it really just depends, what you have going on and what your projections are for the future. But, when it comes down to year end, it might be a great idea if you have a lot of income in 2014 to buy a lot of your supplies that you might need for 2015 so that you can get that income number down on your business entity. And just so you know, through all this, I'm kind of talking in general about flow through entities, which is your partnerships and your S corporations, but then also your C corporation as well. I'll move on. The use of retirement plans, profit sharing plans, and defined benefit plans. If you have the means to be able to do that, you can get great deductions from making a big contribution to your profit sharing or defined benefit plan. In those two plans, you can give 25% of your salary or up to $52,000 as a deduction, as opposed to maybe a 401k or an IRA, which are only about $17,500 and $5,500 without the catch-up contributions. But so really, if you have a situation where you can get into a profit sharing, and if you have a corporation that has a higher dollar money and need a good deduction, that's a great way to go. The one thing that I will point out with that, though, and this kind of gets back into the planning thing, if you were interested in implementing a profit sharing plan or defined benefit plan, that plan needs to be drafted up and signed by the end of the year. So if, just for example, we got into March and I'm working on your return and you say, okay, I got $100,000 of corporate income and I owe, just for round numbers, $20,000 in tax, what can I do? Creating a defined benefit or a profit sharing plan is not going to be an option anymore. And so unless it was drafted and signed by the end of this year, if it was, then that plan doesn't need to be funded right away. It doesn't need to be funded by the end of 2014, but it at least needs to be drafted and you have an idea. But when the fund needs to be the money needs to be contributed into the fund is by the due date of the tax return. So, there's that kind of stuff that you got to think about when it comes to retirement plans. But it's a great opportunity to say, hey, Ronnie, I'm thinking I might need to implement a retirement plan here. What do I need to do right now? And kind of move forward on that.
And when you say defined benefit plan, pension plans, give us an idea of what some of those are. I mean, those are, you're talking about 401k type stuff, or what are you talking about?
The defined benefit plan is kind of your profit sharing plan or your money. I'm spacing on the
Roths or like
no, those are different plans. Those are just your typical retirement plans. It's not the 401k and IRA. It's more there's different plans that actually define in the language of the plan what you can contribute.
And our attorney Greg Boots is really the expert on all of those pension plans and kind of goes through a lot of that stuff, right?
Exactly. Yeah.
Okay.
So
he has a book out. I'll plug it for him called The Private Vault, which goes into a lot of the pension plan stuff, I think, as well. So that's a good one if you haven't read it.
Usually when it comes to the setting up of the retirement plans, I mean, we kind of kick it to the financial guys who really just kind of know all the ins and outs when it comes to that sort of stuff. But no doubt a profit sharing plan, you can get a lot more out of that than something like a 401k or just an IRA.
So we're not talking about those kinds. We're talking about different versions. So On the business property expenses, give us some examples. When you say property expenses, are you talking about like an actual physical property, or?
Yeah, this is related to the 179 and bonus depreciation that we were talking about. Buying equipment's always been a great way to invest in your business, and also to save tax. But for 2014 right now, the limit on Section 179 is $25,000. So, and that's if you've placed in service equipment under 200,000. So, the limits used to be 2 million, and you can get rid of up to 250,000. Now it's like 10% of that, and they've brought it down to 25,000 and 200,000. So, it's still a good idea, but it's on a small scale, and it's on a much smaller scale. So I brought up the example before of the client that I had before, who had a trucking business and had $200,000 of income, and then went and bought a $200,000 truck, wiped out all their taxable income. And, now they would have only been able to take 25,000 and had to depreciate the rest of it ratably over 5 years. So, there is some changes there, but it's still a good way to invest in your business and save tax, just on a smaller scale.
Got it. So, and then repairs and maintenance, you're talking about property management, that kind of stuff, right?
Repairs and maintenance is also goes back to those tangible regulation
Okay.
that we were talking about before, which we'll learn a lot more in the webinar next week. But just to give a little bit of information, if there's a repairs and maintenance dialogue that you have written out that will talk about, hey, this is my policy in repairs and maintenance, then some of those minor expenses like repairing carpet and your rental properties and stuff like that, you're just going to be able to fully expense in the year instead of having to capitalize those and take them ratably over.
And when does that happen? Does that start? Is that now, or is that next year?
Yeah, you know what? The election would allow that to happen now, and so yeah, there could be some stuff that we could work on there. It's just that right now, it's kind of one of those things that we're all still figuring out and learning a lot more about.
Because it's a new regulation.
It's a new regulation, and it just became final recently. So, we sat through a 5-hour training on it and just kind of felt like,
thank God there's CPAs that can sit through 5 hours of the IRS training, and we don't have to.
Yeah. So anyhow.
So deferring debt canceling events, give us an example of what you mean here.
Yeah. So, if there's, obviously, cancellation of debt has been a bigger issue in the past couple years. But for a while, debt canceling events were non-taxable because they felt bad for everybody that went through a rough economic time in the 2009 and 10 years. And so now people might still have properties that are underwater or something along those lines. And if there's any way and if somebody ends up getting debt canceled in 2014, it's 100% taxable. There's no way we're not getting around it. So, just the idea is trying to do what you can to defer that debt canceling into 2015, whether that, hey, let's call the bank and see if we can work something out, or, something along those lines. If there's any way to be able to defer that debt canceling event then to 2015, I mean, it'll save us tax right now. It's going to be inevitable, but as an accountant, what do I want to do? I want to either defer tax or avoid it, and so if we could put it off, then that's not a bad route. Another thing could be disposing of a passive activity in 2014 if it'll release all passive losses. If you have a rental property that has taken a loss over the years, or something along those lines, if you have a lot of passive income in a year and you can make a decision to sell off a house or a property, if it'll release all those passive losses from prior years that you wouldn't be able to take, you might be able to save quite a bit in that net investment income tax arena, or just overall not having passive income on your tax return. So just a few ideas like that are things that we talk about not all of these ideas will fit into everybody's individual plan, but hey, maybe one of them will work for you, and that's what we're looking for here.
Well, and also too, it's kind of tough sometimes to sit here and try to do tax planning with several hundred people on a webinar and talk in general. So it always is good to get you on and work one-on-one with somebody like Ronnie to do that. We'll talk a little bit here in a minute about how you might be able to do that and work with Ronnie directly through a tax plan session to here towards the end as well. But so let's move on from the business side and look at the individual strategies and what we can do from an individual standpoint when it comes to the tax planning here at the year end. Give us some ideas here based on what you've written up.
We've talked a little bit about making estimated tax payments already, but one of the things that we'll always do is when you get your tax return back, if you need to make estimated tax payments, it'll say in your packet, and making those payments timely is important. I've had clients who kind of are nonchalant about making, for example, we'll tell them, hey, you need to make $10,000 per quarter. They'll wait till September and then they'll send 2 payments or something along those lines. But what I like to do is I like to send out emails to a lot of my clients that I know need to make these estimated tax payments, and just shoot out a reminder to say, hey, just a reminder to make that payment. But if you don't make those payments timely, then the IRS will get you for some interest and penalties. It's not a huge amount, and a lot of times people don't care about it. But from my end, I don't ever really want you guys to get penalized. Even if it is just $200. From your end, you might say, well, hey, it's worth it for me to hang on to a little bit of that money and make the payments later. And if that's the case, then that's just, for you guys to decide. But from my end, I want to try to make sure that you guys are 100% covered that way. Moving on down the list, realizing capital losses against capital gains. I had a client in here who I was talking to, and he had mentioned that everything else was pretty much the same on his tax return from last year, except this year he had a $200,000 capital gain. And so on that, he was going to, he's going to be on the hook for about 20% tax. So, one of the things that I just kind of suggested to him was, hey, you're going to owe about, $40,000 on that 200,000. But if you have, any other stocks that are sitting in your portfolio that are sitting at big losses, or that you have losses, you might want to consider realizing some of those losses just to offset some of that gain. So, just a quick conversation that him and I had, and he goes, hey, you know what, let me look at my portfolio, and, if there are some things that I can sell off, then I'll do it just to, to be able to save some of that tax. So
basically what he's doing is, just for clarity here, he's just taking stock that he has in his portfolio now, selling it now, and then just buying it right back again. Is there a period of time you have to wait or anything?
No, he doesn't even have to buy it back. I mean, he can just keep it.
Well, but if he wanted to keep it.
Yeah, if he wanted to keep it, then yeah, you can turn around and buy it right back if you wanted to.
There's no lag time.
No, there's no lag time there. But when you have that realized amount, that means a sale was made. So yeah, I mean, it's just a strategy that somebody can implement if they want to realize some of those losses and not pay so much tax. We've talked about a little bit about contributions to retirement accounts. On the individual level, you might be looking a little bit more at, your IRA, 401k. And I kind of discussed some of those limitations already, but, if you have a day job and you have some things going on the side, you might decide through your day job, hey, I just need to max out my 401k and just, put the $17,500 in there and get that tax deferred amount right now if you decide. And that is especially if you're in a little bit higher of a tax bracket, you might definitely want to do that. But there are limitations to all that sort of stuff. So, those are types of things that we would want to talk about.
Great. And so as we are sitting here looking at our year end, obviously we want to start pulling together now some of our data, where we are, where we're sitting. But as we do that, obviously some of us are out there working on this stuff, and we do it on our own. We make mistakes, and then we have you guys clean it up, right? So give us some ideas of what are some things that are happening when it comes to things you see quite often when it comes to mistakes that we're making as business owners, investors out there.
Well, sometimes it just seems like we don't get everything. And then we're going and preparing the return and something else will come up, and we miss stuff, and then it's kind of like we kind of end up owing money because we missed something. So just being thorough there.
Well, let me just be fair for all of us business owners. Not everything comes in all to us right in that first month or two. What's a good way for us to track like that income because it's mostly income, right? That income comes in, and all of a sudden we see some form come in from a place 3 months. I mean, I've had it happen 3 months later. All of a sudden I knew it was there. I just totally forgot about it.
Yeah.
And it's this dividend income or whatever it might be.
Well, what we like to do is in our tax planning seminar, or the time that we'll sit down with people, and what I've done over the years is, you'll get kind of a list of stuff from me to look out for. So, I'll look at your prior year tax return and I'll end up saying, hey, you know what? Last year you ended up getting a 1099-R, which is a distribution from your retirement account from whoever's holding it. Are you going to get that this year? And so, if you sign up for a planning seminar with us, then I'm just going to go through our consultation, and I'm going to go through your prior year tax return, and I'm just going to kind of say, hey, did you have this? Did you have this? I'm going to look at everything that you reported last year so that nothing kind of slips through the cracks. If you had something brand new, then I'm not going to know about it unless it was conveyed to me. So, some of that sort of stuff we definitely see happening pretty often. But, other mistakes is that, and I guess I kind of alluded to this already, but let's not wait till March or April to figure out how to save. I mean, we definitely have, the time right now to be able to figure out what exactly you're going to owe. The worst thing that can happen as a CPA that I've had is to prepare somebody's tax return in March or April and then have to call them and say, hey, you owe $30,000. And to me, that type, and there's penalties in there because you underpaid. That's the worst thing, because we could have set up quarterly tax payments, and we could have maybe done some other planning to contribute more to your retirement plans. There's a lot of different things that we could have maybe done at the end of the year that would have reduced some of that burden. But I guess just kind of going down the list here, I kind of just wrote out a couple things. Don't let saving tax be the main motivator of an expense. I mean, you might end up saying, hey, I really want to save tax. But if you call me up and you say, okay, what can I do? And I look at your stuff and, it's all pretty straightforward. And I say, well, you can always donate to charity. That's always a good one, right? Donations to charity. I mean, it'll make you feel good. But the reality is, if your effective tax rate that you pay is 15 cents or 20 cents, is it worth it for you to go, give $1 to save 15 cents? That's something that needs to be a motivator. Now, on the other hand, I might say, well, you can plug an extra, $5,000 into an IRA. Well, and that'll save you $2,000 in tax because you're in a higher tax bracket. Well, that might be worth it to you because in your IRA, your money's going to appreciate. And so, there are some different things there, but we shouldn't let just saving 20 cents on the dollar be the main motivator for why we're doing stuff. And then, another thing is we can't ignore the AMT, the alternative minimum tax. And I don't expect any of you guys to really fully know what the AMT is, but your CPA should never be ignoring the AMT, because if you have huge amounts of deductions in, say, mortgage interest and charitable contributions and kind of itemized deduction type stuff, then the alternative minimum tax ends up kind of disallowing some of that, and then you end up owing some tax through there. But So there's just a few little mistakes there that we can avoid. But we talk about mistakes. The mistakes cost us more money, but what the mistakes also do is make it seem like the CPA client relationship isn't what it should be. And I kind of started off talking about that, want to talk about it a little bit more, is that our relationship with each other should be almost like a partnership where, if you have ideas and you have things that you're wondering about, hey, you know what, pick up the phone, because your CPA is going to add value to what you're doing. And that's kind of one of the main messages that I wanted to share tonight in this year-end tax planning.
Right. So a couple things. As we're talking about the tax planning again, I'll let Ronnie kind of start reading through some of the questions here. So go ahead and ask more questions that you have, and I'll have him kind of read through them, and then we'll get to answering those. But go ahead and, again, if you joined us late, go to the bottom of the page here, ask your question, type in your name, all that. When you hit submit, it'll come back up again, and just hit play again on the video. Ignore the blue live chat feature there on the right, and we'll go through that. Now, when it comes to year-end tax planning, we do have a one-on-one sessions that we do with our CPAs, or have you do with our CPAs. So if you're interested in sitting down with one of our year-end tax planning sessions, it's a one-on-one session. Ronnie is one of the CPAs that you can sit down with. And what we do is kind of go through your situation, look at where you are now, where you want to be in terms of tax and all that, and what you can pay, and then kind of start digging through it. Like we said, on the webinar, we're dealing kind of more general, looking at the big picture, mainly because we can't dive in individually to looking at each one of your situations. So that's what the year-end tax planning session is all about. To join that, because of it being the year end and we're getting close to the end of the year and only have a limited time left, we've had this out there for about a week now. We've got until next Wednesday and this goes down, so we won't have this available anymore after Wednesday. So if you have an interest, or before, depending on our schedules as we book this out, if you're interested in it, just go to andersonadvisors.com/ just like it shows here, buy-now. And if you use the promo code year-end50, you'll get $50 off that. So it'll only be $200 for the year-end tax planning session. So it's usually, give maybe a little bit more explanation on that, more than I do. Ronnie, you do.
No, that's fine. And I mean, the fee that goes along with it, I've already alluded to this, but our goal is to be able to provide value to you. And for me to be able to sit down and kind of get to know all your businesses and kind of get to see exactly what you have going on, it is good value for what we do at year end. I've done this with clients every single year since I started doing this type of work, and I appreciate the opportunity. Kind of just so you know, the way it'll work is if you do sign up, you're going to kind of go through one of our client coordinators. The client coordinator will send you an email that says, hey, this is some of the stuff that we're going to need. And she'll end up saying, she'll end up just kind of coordinating with you and setting an appointment with me. Once the appointment's set, I'm going to kind of pull out your files, and then I'll look at what you have going on, and then I'll send you a series of questions and requests that end up kind of just letting me know a little bit more specifically what you have going on and what kind of opportunities that we have. And so we'll go through that. At a minimum, what I want to do is make sure that you're not going to owe a big amount of money in April. So, hopefully after looking at your guys' situations, there'll be some suggestions that I could make. But at a minimum, the fourth quarter estimated tax payments are due January 15th. And I'll be able to at least let you know if you need to make a payment, and can get you a voucher on that. So, I think it's definitely worth it to be able to do that. And, what I'll say is the proactive business owner is going to be the one that saves a little bit more. So
perfect. So questions, anything here that you want to start going through? And some of these questions, we may not be able to get to all of them. So we're approving these as they come in, and then we'll If we can't get to them right now, we'll get to them by writing out the answers later. But anything else right now?
Yeah, Robert, he made a good point about capital loss carryovers and kind of the relationship between short-term and long-term capital losses. One great thing that he brought up and reminded me of is for the taxpayer to kind of understand what their carryovers are. I had a lady kind of give me a call who had a lot of she was a little anxious because she had a big amount of income this year. Well, talking to her on the phone, I looked at her carryovers, and she had a very large NOL, net operating loss, that was going to wipe that out. So, just kind of put her mind at ease for now, but was good to at least understand the carryovers. When it comes to capital loss, capital and capital gains, those carryovers go year over year. So if in year one you have, a short-term capital loss of 10,000, and then in year two you have another short-term capital loss of 10,000, carrying over into year three is going to be a short-term capital loss of 20,000, and so those ones will continue to carry over until they're used. So hopefully that kind of helps out. I know, Robert, you had a few questions in there, and I was trying to kind of put the answer all into one there, but hopefully that kind of gave you what you were looking for.
Perfect. And so again, we want to thank everybody for joining the webinar today from all across the country. We got people from Florida, it looks like, and
Texas,
Georgia, Texas, San Diego, St. George.
Yeah, no, I appreciate all you guys coming in. Oh, hey, I see Troy Sakal here from Las Vegas, who's a friend of mine, and appreciate you being on it here. And but I appreciate you guys coming on from all across the country. And please, if there's anything that I can do to help you guys out, I'm definitely looking forward to it. I like working with the clients kind of one-on-one, and just want to be able to have a good relationship with the people that I work with. So feel free to fire away and email me with questions. And if you do sign up for the year-end planning, hopefully I'll be able to work with you, or if not, there's other competent CPAs here who will definitely take care of you.
Great. Again, thank you all for joining the webinar. The next one planned is for next Wednesday, again, for tax team members. So you'll get an email regarding that one as we go out. And want to thank everybody. If you did miss some of the beginning of the webinar, you can go back as soon as the webinar is over on the same page. Just refresh the page as soon as you're done, and just hit play, and it'll start right from the very beginning of the webinar. So it's very simple to get back in and listen to the whole thing if you want. Thank you all again, and have a great day.